I'm Phil Borkin from JBWere's Investment Strategy Group. Well, after quite a strong start to the year for global equity markets, we've seen signs of consolidation emerge over the past week or so. The S&P 500 was down 2% or so last week, after being up about 11% over January and February. And I suppose given the strength of that rally, it's not really unsurprising that markets have paused to catch their breath somewhat. Certainly they've had plenty to cheer this year, whether it's a Fed that's been more patient with regards to future tightening, a solution to the US government shutdown, more positive headlines regarding the conflict between the US and China on trade, or signs that the Chinese officials are more aggressively stimulating their economy. All these were factors that were weighing quite heavily on sentiment over the second half of the year. The question really now though is where to from here? We started out the year thinking 2019 would be one of modest, positive, but volatile equity market returns, and that expectation hasn't really changed. So it's fair to say we're turning a little more cautious on return prospects from here, and we think that caution is justified when we look at the tone of global economic data at the moment, which is suggesting the global economy has slowed quite meaningfully over the past quarter or two. So to answer the question of where to from here, at least for equity markets, it really comes down to a question of where to from here for the global economy. Equity market valuations are now looking relatively fair. So what we really need to see for this rally to be sustained or even push higher is an improvement in the earnings backdrop. I must acknowledge that that is our expectation, but it is going to require a stabilisation in the macro picture to justify that. And that's where much of our focus is at the moment. The March quarter is admittedly shaping as quite soft for the global economy, but it is our view and the view of our external research providers that that is really reflecting a number of temporary influences that should wane as the year progresses. When we look forward, we're already seeing some positive signs. US financial conditions have eased. We're expecting to see some positive fiscal stimulus in the likes of Europe and Japan. And I've already mentioned about the stimulus coming from the Chinese officials, which, if sustained, should not only be positive for the Chinese economy, but positive for the global economy overall. And if we do see that, then that should be favourable for that earnings environment and be favourable for equity markets overall. But I must admit, it might seem like quite a large leap of faith to be basing an investment view off an improvement in the economic data this late in the cycle. But at this stage, we still believe it's more of a mid-cycle soft patch than the end of the cycle. We still see pretty low chances of recession, at least over the next 12 months. Now, I must admit the risks are heightened though, and we're not naive enough to have blind faith here. If the data doesn't turn and justify our positivity, then we'll be assessing that pretty closely. We've got macro data on a pretty short leash as a result. For investors, I think it's just a case of being realistic at this point in the cycle. We don't believe the cycle's over, but given the rally we've seen, given the volatility we expect to see, it's about managing expectations at this point. Look, I'll leave it there, but of course, if you have any questions, please don't hesitate to reach out to your JBWere advisor.